The question that I get asked the most is, why has the market not crashed yet?
I don't foresee why it should have crashed, except for the reason that starting valuations were very expensive in broader markets. Even today, they are expensive. This is a turnaround quarter for small caps. Now, we are expecting a 35% growth in small cap.
But Sonia, what Gautam didn't speak about was valuations. That the valuations in small cap, in a lot of pockets, they're still out of whack. We've seen some price correction already. A lot of small caps have corrected 30-40%. But even after that, when we evaluate many of them, they still look expensive.
Gautam was telling us in the break that with the way silver has surged, I think people in your family are like, oh, kuch aata hi nahi hai.
You didn't know, you didn't forecast, yeah. What were you doing?
Did you miss out on silver completely?
Yeah, completely.
But it's interesting because silver is not just a commodity anymore. Anything and everything now needs silver, whether it's solar cells, whether it's EVs. Is there more to go?
I'm not selling my silver. I'm not selling my silver mines. I'm not selling my gold. I'm not selling my gold mine.
But you've been in this trade for very long, right? Over 2-3 years.
I've been for very long. I've been very patient also. Silver didn't do for anything for 5 years.
He's reaping the rewards now.
But my only problem with this is, once it becomes a crowded trade, which it has, then retail gets sucked in the last 10% of the rally. Is that the way to look at it now? If someone's missed out on silver entirely, is it too late?
I think if any asset class, whether it is equities, bond, commodities, if it has done very well and you miss the big part of the upswing, if you still want to come in, you'd come in with two things in your mind. One,
hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Now today on the show, I have two gentlemen who have, I think, tracked the markets for over 30 years or more than that actually cumulatively, and are here to tell us how to approach 2026. We have big events upon us. There's the union budget. There is so much in the geopolitics as well. One gentleman is a favorite of the Money Mindset and a usual suspect, Sridhar Sivaram. He's been here before. I also have Gautam Duggad of Motilal Oswal here with me. So gentlemen, thank you so much for being on the show.
Thanks for inviting.
Thank you for inviting.
You have been here once before and you are a brand new addition. So thank you for taking the time out.
Thank you.
So Sridhar, I want to start with you because, this is a market that is very confusing for everyone.
Yeah.
Whatever you thought would work has not worked in the last in the last couple of years. And, commodities like silver, for example, after not having a performance for 10, 15, 20 years are now surging.
Correct.
But what's the outlook for 2026? Let's start with that.
Yeah. So I'll leave the commodities aside. We can discuss that later. But a broad view for 25 was that it's a very difficult year. We had a lot of macro headwinds. On top of that, we had valuations which were slightly stretched for the market and earnings were decelerating. Broadly, it's played out. So if you see how the earnings growth have disappointed for the broad market and the tariff-related negotiations haven't really gone to any, hasn't fructified in the way that we would have anticipated. So that leaves some uncertainty in the market. We think the same will continue. The same playbook continues this year. The only difference is that as we stretch into the next year, which is FY27, from the, I would say, second quarter onwards, we'll start seeing earnings slightly accelerate. So we are in the camp which believes that we'll have, the broad nifty earnings will be in the 15% range. So one of the issues which the market had last year may get corrected, but the external macro headwinds may still continue. The other good part is that the internal macros are broadly okay. Our inflation is broadly within the range that you want, which is, I was an inflation bull last year and I've been screaming on top of the voice that, the RBI inflation numbers are totally wrong. I've been proved right on that. And I think there is a room for another 25 basis points rate cut. If all this happens and government has stimulated the economy through both from the direct tax and the indirect tax, it's highly possible that the economy can recover slightly better. I'm not in the camp which believes that we see a 8% GDP print. The broad economy doesn't feel. Most economists will tell you that there is a statistical aberration because of the low inflation. But having said that, we are still in the 6.5-7% GDP growth. So I'm not very bearish for next year. I think if earnings are 15%, markets can give earnings related returns.
Okay, so not very bearish for next year,
Yes.
for 2026.
Yes.
That's a good start. But Gautam, I want to get you in on this because the question that I get asked the most is, why has the market not crashed yet? This is a market that has been very, very resilient, but there are so many reasons why the market should or could crash. But why hasn't it crashed yet?
So look, I don't foresee why it should have crashed, except for the reason that starting valuations were very expensive in broader markets. Even today, they're expensive. You look at mid-cap index, it is still trading at 28 times. Small cap is 24, 25 times. The long period average for small cap is 16, 17, and somewhere about 21, 20 for mid cap. So they are trading at 30 to 40% more expensive than their own long period averages. That was one of the reasons they should have corrected. They've time corrected. Last year, if you see calendar 25, Nifty has given you 11% return, 10th consecutive year of a positive close. Nifty Midcap 100, which we take as a benchmark, has given you 6% return. So Midcap index was up 6th year in a row. And small cap has been volatile. It was down last year around 5 or 6%. Now, why it has not crashed? One of the single largest reason is the flows. Last year, you got $90 billion of domestic flows. CY24 was $63 billion. So if you add up the 2 years, $153 billion have come in from domestic savers. Foreigners sold $19 billion last year and about $1 billion in 24. So against an outflow of $20 billion, you had an inflow of 153. Of course, a lot of that got consumed by the primary market because you've seen flurry of IPOs, QIPs, promoter blocks. So iBankers have been really busy. Now, that has ensured two things. In normal circumstances, if the primary market was not so active, this $90 billion would have found its way in secondary market. It would have resulted in some bigger rally in the other, the broader market. But because it got absorbed by primary market, we didn't see that kind of a deluge in secondary market. Otherwise, valuations would have gone out of whack. So in a way, it's good that a lot of that money which domestic savers are putting into equities is finding its way in IPOs and so many other forms of fundraise. And that's one of the reasons why market has not crashed. Second, despite all the stagnancy since September 24, the mid-cap part of the index or coverage that we have, we cover about 100 mid-cap stocks now and 160 small caps. So our coverage of 355 stocks, if you look at it, mid-cap, the 100 stocks, the earnings growth has been 2x of large cap. So in FY25, the large cap part of our coverage has delivered 5% earnings growth. Mid-cap was 10%. This year, we are expecting 8 to 10% in large cap FY26. Mid cap is still 20%. In fact, this will now be the 5th consecutive quarter of a mid cap universe doing more than 20% plus. And it's coming on a high base, Sonia. This quarter, we are expecting 22% growth on a base of 27.
In
right?
mid-caps.
Mid-caps. And there are 100 stocks, so almost an index, you can say. Now, there are obviously a lot of anomalies. You have one OMC, which is putting a disproportionate influence. So even if you remove HPCL, my mid-cap earnings growth this quarter is 18. Last quarter was 25%. So mid-cap valuations, you can still justify by talking about growth. The real issue was small cap, where for 6 quarters in a row, the growth was either 0 or minus 4 to 5%. The heartening thing is, this is a turnaround quarter for small caps. Now, we are expecting a 35% growth in small cap. The drag of small cap financials is going away. And the base is obviously very conducive because you're at 5 to 6 quarters of no growth. So small caps are now finally joining the earnings. And as Sridhar said, we are also at 17% forecast for Nifty next year. The interesting thing in Nifty, however, is 2 years back, just before elections, April 2024, when we first published our FY25 EPS estimates for Nifty, it was 1142. Today, 1142 is not happening even for FY26. So we achieved 1014 rupees in FY25 versus the first projection of 1142. So growth was estimated at 14%. Eventually, the EPS grew 1%. Absolute profits are of 4-5%. This year, again, we started at somewhere about 12%. Now we are ending at about 8%. So in FY26 also, we are talking about 1080 rupees of EPS. So earnings story got pushed back by 2 years, but the flows ensured that the market didn't fall beyond a point.
Interesting. You're saying that this quarter was a turnaround quarter for small
This
caps.
is expected to be a turnaround. We'll
By
know on
the end of
15th of
it.
February.
By the end of it. You concur with his view? Because I think you're the second person telling me that. I had this chat with S. Naren a couple of...
Because the base is so favorable. See what happened in small caps. NBFC, specifically MFIs, they posted losses last year for last couple of quarters. So that quarter is now coming in the base. If you look at it in absolute terms, okay, because year-on-year comparison gives you a lot of deceiving picture. December 23, 160 small caps of Motilal Oswal coverage. The total profit was 18,500 crores. December 23 to December 24, that profit went down to 15,500 crores. This quarter, we are expecting 21,000 crores. So if you look at it on a 2-year basis, the CAGR is hardly 6-7%, from 18,500 to 21,000. So about 12% kind of a growth. So that's a 6% CAGR. But YOY comparison is very different because the base is completely depressed.
So is it fair to assume that if this is a turnaround quarter, ends up being a turnaround quarter for small caps, is it fair to assume that the next wave of opportunity comes in the small cap space? Because this is a space, mid and small caps, that have not given you great returns in the last few years.
But Sonia, what Gautam didn't speak about was valuations. That the valuations in small cap, in a lot of pockets, they're still out of whack.
Very expensive. Yeah.
So that still leaves some room for either a time correction. We've seen some price correction already. A lot of small caps have corrected 30-40%. But even after that, when we evaluate many of them, assuming a blue sky scenario for next 2 years, they still look expensive. So we are very selective. We've not, as I said, see, we don't have a benchmark. I'm part of a family office. We don't have a FOMO. We don't have, to look at distributors. So the way we look at the market's very different from a lot of my other, fund manager peer group looks at. So for us, we don't have to worry. If we miss one stock, it doesn't matter for us. So it's a very different way of...
It's a different approach.
Yeah, it's
so
a very different approach.
Very top
so
down.
we look at, the way we look at is, when we are buying a stock, can the stock double in 3 years? Which means I need an earnings growth of at least 20% and an assumption that there'll be no derating. Broad framework. I mean, we all go wrong with our assumptions, but that's the, broad framework we look at. So for that, if my starting P is 40, 50, 60, the assumption is that you will get derating. I mean, that's the basic assumption you have to make. Then you can't, our targets are not met. So there are enough stocks to look at, and we've discussed many of the other sectors in the past which nobody wanted to look at, and they've been multi-baggers for us. You still find those.
So I'm going to come to that in a bit.
So add to that point, Sonia, NSE 500 is the broadest index, 92% of market cap for India. Last year, if you look at the median stock return in NSE 500, it was down 20%. But index was not down that much. Index was hardly flattish. In fact, Nifty was 11% up, Nifty 50. It was better return than CY24, despite all the talk of, nothing happened. But the real pain was in the portfolios. A lot of small caps, mid caps, as Sridhar was pointing, were down 20, 30, 40%. Which is the worst performing stock of Nifty 50 last year? It's Trent. Trent is down 40%. The stock, which had 125 P, in March 25 was at 8,000 rupees, when the growth in top line was averaging 40%. The stock had run up 7x from 1,200 to 8,400 in 3 years, April 22 to March 25. Growth came down from 40 to 34 to 28 to 17. Stock tanked from 8,000 to 6,500 to 5,500, 4,000. Now it is below 4,000. Still the P is 80.
So what do you do as an investor with a stock like that?
When the dispersion in earnings and stock price returns is so high, your job as an asset allocator becomes even more difficult, because a lot of time index P hides many things. When you talk about 21P, that 21P is a blend of 5 to 10P of metals, utilities, PSU banks, and 40 to 50P of consumer and some high flyers in tech. So you have to get your earnings right. You would have said 17% top line growth for a trend is excellent, because the peers are still growing at 8-10%. But market was paying 100P for that 40% top line growth. So when 40 came to 17 over 9 months, stock fell 50% almost from 8,000 to 4,000. And within Nifty, these are like the 50 most large, liquid, well-tracked companies. The best performing stock gave you almost 70% return. I think it was Shriram Finance. And the worst performing stock gave you 40% return. Top 50 companies roughly. So the dispersion in both earnings and the returns is high. And this is typically the case for last 2 years. And now we are sitting in a situation where, when you try to project blue sky for big indices, 20% looks very difficult. Because 55% of my profit pool in Nifty is coming from 3 sectors: consumption, IT, and BFSI. I can't see how they will grow at 20%.
And we've seen what happened with, say, a TCS.
Because
right?
look at financials. Yeah. The total profit at the bottom of the cycle in 2018 for my coverage universe of 70 stocks was 48,000 crores. That was the worst year when credit cost had spiked, people had reported losses. That 48,000 crores in 2018 went to 5 lakh crores in 2025. So 10x in 7 years. Entire asset quality tailwind played out. 5 years in a row, PSU banks reported 15% plus ROEs. You've never seen this kind of period in the last 30, perhaps Sridhar can correct me if I'm wrong. For 30 years in a row, if you go back, you will never see a period where PSU banks for 5 years reported 15% plus ROEs.
So Gautam, we did a show with Sonia in February 21.
I remember that.
Only on PSUs
PSU banks,
and PSU banks.
And no one was touching PSUs
Yeah,
that
and nobody
time.
was touching it. This is exactly the point we were making at that time, that so much of the provisions have already been made and you're buying them at 0.5 book. It's very difficult to go wrong, but nobody wanted to listen to us. I mean, it played out over the next 5 years. So I'm just saying that, markets gives you opportunities. The question is whether you're brave enough to take those or you want to follow the herd and buy the stocks that you mentioned.
But recency effect also played out. Because now that Sridhar mentioned that point, I just remember 7 years between, I think, December 12 to December 19 or 20, the total PSU market cap, forget banks, total PSU market cap was, languishing at 19-20 lakh crores. December 19 to December 25, it's compounded at 31%. 74 lakh crores now. In fact, the wealth creation study that Ramdevji published last month, out of the 10 stocks which he categorized as a blend of fastest, biggest, and most consistent, this is the third category. 4 are PSUs in that. First time after many, many years.
PSU banks
or
just across?
Across PSUs. In fact, last year, SBI out of nowhere gave you 40% return. Luckily, we have the highest overweight within our model portfolios. We are still underweight on private banks. So what the point I was making was, if banks are now converging with credit growth, because if your credit growth is 13-14%, today you can't get 40% profit growth because your credit costs have already there in the base 25, 35, 40 basis point. It can't go below that, right? So big chunk of the profit pool of Nifty is growing in that 12-13% band. Consumer companies you have seen last 5 years. Last 10 years, there's not a single consumer company in India, staples, which has given you even 10% top line compounded growth. So earnings growth is also in that 8-10%. And IT, you all know, 8-10%. So difficult to conceive a 20% growth scenario.
But when you see the larger picture, Gautam, let's talk very realistically, right? There's something in the India piece which is not working. Now, jobs also is an issue. TCS, we've seen large amount of layoffs. Growth is an issue. It's been stagnant for a while. I mean, of course, if you compare to peers, then growth is much higher in India. But if you look at just India-specific, domestic growth has been lagging. Inflation is an issue, consumer inflation, etc. What do you think is the fix? Where is India going wrong, and what do you think is the need of the hour for domestic consumption to pick up in a big way?
So look, I mean, there's no one particular medicine that you pop and things will sort out. I think the biggest problem in the last 7-8 years has been because we've done so well on financials. There's a lot of discipline in lending today versus what used to exist 15-20 years back, which is why you are seeing banks balance sheet the best that they've been in the 3-4 decades. The flip side of that is your credit growth has taken a bit of a knock because everyone is disciplined while lending, and even the corporates are not trying to gold plate, for want of a better word, because they know there is IBC now, which was not existing in 2005 to 15. So insolvency, right? So today they don't want to take loans which will, which will lead to seizure of their assets. Earlier, it never used to happen. You take a loan and it's a bank's headache to recover that. So your private capex, while it's been discussed ad nauseum for last 10 years, not picked up because the components of capex are very different today than what used to be there in 2003 to 12 cycle. You are building ultra mega power plants and huge capacities across. Today, a lot of things are happening on an inorganic basis after IBC, and because the demand is not that strong, you're still talking about capacity utilization in the system, which is in mid 70s, right? So a corporate is not compelled to put that capex. So that virtuous cycle of capex, consumption, jobs, that got stalled somewhere, right? Second, last 3-4 years, consumption has also taken a bit of a knock. I'm mostly talking from a listed space point of view, but if you aggregate listed, unlisted, it's not done really well. Sometimes it is rural which was lagging, sometimes it is urban which was lagging. But the reason I mentioned that statistic of not a single consumer company in India growing at 10% top line is symptomatic of the fact that something has not worked there. Of course, you can still argue that penetration levels have gone up and per capita consumption has, to an extent moved up. So the percentage growth may not be in the same magnitude. Because I remember 2007 when I started tracking consumer sector, the oral care penetration in India was 72%. And Colgate for 6 years in a row, I remember that data, posted a double-digit volume growth between 2008-9 to 2014. 2014, the oral care penetration went to 90 to 93%. Now look at the top line growth of Colgate for last 10 years. It's 4 or 5%. That is pretty much the story across the consumer companies. But the growth is emerging in new segments. So you have suddenly proliferation of discretionary baskets which have emerged, which were non-existent 10 years back. And it's been the case everywhere. When Sridhar would have started his career, while deciding allocation in financials, he had to make a choice between a private bank and a PSU bank. Progressively, NBFCs emerged. 10 years back, life insurance companies started listing. 5 years back, AMC started listing. Now there is a whole host of capital market companies, broker exchanges, wealth managers which are there. And hopefully in the next 3-5 years, you'll have fintechs also. So the investability options for an asset allocator has gone up across the board, be it consumptions, financial, tech, industrials, healthcare. So to address your point, I think it will require combination of solutions. Manufacturing, this government has tried a lot. In some pockets it is working, in some pockets it is not. Because look, the big raw material for manufacturing is demand. Right? You have to see demand growth picking up. Before that, capacities won't come. Without capacities, manufacturing won't take off. So PLI has worked in mobile. It's a well-documented story. But in other segments, not that successful. Maybe it will take time. Right? So,
Okay,
so those are a few things.
I want to get Sridhar in on this. So he made a very interesting point where this virtuous cycle of capex, consumption and jobs is getting stalled across the board, right? Private capex not picking up, consumption has fallen, and jobs, we're seeing the situation. It's a scary situation right now. Maybe because of AI, maybe because of, India falling back on certain technology, etc. How do you fix that?
Yeah, so I think the government is trying to fix that by giving more money in the hands of people. So I think the first thing they did was in the budget when they cut the tax slabs, and almost 1 lakh crore went into the hands of people. Even then, we actually were not in favor of a direct tax cut because it benefits only 2 to 3% of the population. And so you and me also benefited from the tax slab change. Whereas, do we really need that? I mean, I'm happy I'm getting some more, but the point is if the government was looking to stimulate a broader economy, indirect tax is a far better option. Like we were suggesting that you cut 5 rupees from petrol diesel and it just flows through the entire economy, and you would have used up maybe 1 lakh crore, roughly similar amount which the government has used up now. The indirect cut that we saw in the GST, that helps stimulate demand. So I think the government is trying to stimulate demand by reducing taxes and by increasing capex. So as we discussed that, roughly 11 lakh crores is the capex number for the government, and it's been in the 10-11 lakh crores for last 2-3 years. So that gets more projects. States are also doing a capex. So if you add the state and the center, that number is fairly substantial. So those are the ways the government is trying to do. I think the government has done enough. There is only that much that the government can do. Beyond that, I think the economy has to, take effect on its own, which will happen, which sometimes happens with a lag. I mean, the fact that 1 lakh crores of extra direct tax benefit, did people start spending immediately? No. Maybe it happens with a lag. We think that it happens with maybe 3 or 6 months lag. Same for the GST cut that we saw, that it happens with a lag. We are seeing at least auto demand happen immediately. So you're seeing the, instant gratification as far as auto is concerned. In many of the other sectors, it may take some time.
Okay, so the job situation is pretty scary at the moment, right? I mean, TCS firing 30,000 people in 6 months is not a small amount.
So Sonia, we've been talking about this AI having an impact on Indian IT sector for more than 2.5, 3 years. So we've been very underweight Indian IT sector. And, very early, one of the founders of one of the large IT companies told us that, this AI is both a threat and an opportunity. But unfortunately, the threat comes first and the opportunity comes after that, once you restructure your organization. And it's very difficult to, restructure a monster or a large organization like, say, one of the IT companies, all the top 3 IT companies. So our view is that this is a dangerous situation. What I think the only saving grace for India, I would say, is what is happening on the GCC side. So if you see that currently we have about 1,500 GCCs registered, what I understand is another 1,500 have applied for registration in India. But the only difference here is that the skill sets required in GCC is a chartered accountant, an HR person, all sorts of other activities, not just IT. Whereas the skill set that is losing the job is predominantly IT. So that is the dichotomy that will happen. And I think it happens every, 10 years, people have to reskill themselves. I think that's what will happen. This is a difficult situation, not just for India. India has a larger problem because our surplus labor is significantly higher. But this is going to be a challenge. Our next 5 years, in terms of just disruption, not just because of AI, disruption because so many other innovations and the way we do things are going to change. I think it's going to be very exciting. And as an investor, the old thesis that you buy, hold, and sleep, that is completely gone. You have to be on your toes. Literally every day you have to, look at what is the new invention, what are the new changes that are happening. And you don't need to react every day, but you need to be aware that, these things are happening and these things can affect my portfolio.
That's why I really don't envy your jobs, because of the amount of research. I think even despite being in this market for over 20, 30 years, you can't say, okay, I know it all. And
no,
then
you can't.
Gautam was telling us in the break that with the way silver has surged, I think people in your family are like,
you didn't focus. What were you doing? You're head of research, you don't know where the silver will go. So, I mean, see, there's so many asset classes which change direction every now and then. And there's this new breed of investors which have come in the last 5 years. You had this is a well-known statistic now. You had a demat account of 5 crore in March 20. Today you have 21 crores. So this 16 crore, maybe there are duplications and all, but even if you take 50% of that figure, there's a whole breed of new investors which have come in. And they need that adrenaline rush, right, which stopped in 2025 because the F&O market became a little less active. You have this data of VIX at a multi-year low rather, India VIX, which is basically robbing investors or the traders or the speculators of that instant fun that they were having in 2022 to 2024. So people have shifted their playground to commodities and all sorts of things. Now, given the kind of returns you've seen in precious metals, they may continue, but people who are coming with the expectations कि boss 2 साल में gold double हुआ, फिर से 2 साल में, they may be in for some sort of a disappointment. And by the time that realization dawns upon them, the game would have shifted to some other asset class maybe.
Did you miss out on silver completely?
Yeah, completely.
So you never thought that this is a metal that will, because I know Sridhar got it right.
Yeah, he's been
telling
very
me for
vocal
years
about gold, silver, I'm sure. So see, silver never was in a discussion also till about 6 months back, right? Gold always remains in a discussion because it's a big asset class. Everyone has an asset allocation. All the wealth managers you go to, they will talk about put 10% in gold, 15% gold. Luckily, what in gold has worked well for us is that we've had a very strong bullish positive call on Titan 17 years in a row. We've never changed that call. So even yesterday when I was looking at data from demonetization day, demonetization happened almost 9.5 years back now. If you compare, because one of this thing that I've been telling a lot of people, you buy Titan instead of gold. But obviously they have their counter that you can't, wear Titan share certificate on the neck and go to the parties. Titan was a well-discovered stock in 2016. A lot of people were covering it. It's a pretty big market cap in those days standards. Stock was expensive, 40 times. I remember doing 4 or 5 US roadshows, pitching Titan as a top idea for those 3-4 years. From the price was 340 on the day of demonetization. And with such stocks, you always get the pushback that things are expensive. Every subsequent roadshow that I did in that territory in those 2 years, the price used to be 30 or 40% higher. So between 2016 to 2018, it moved from 350 to 900. Right. And of course, earnings were also there. With Titan, you always have this patchiness in earnings sometimes, depending on the commodity price. Yesterday, when I was looking at it, because it's still part of our model portfolio, number one discretionary top idea and things like that, it's up 12x from demonetization day. In less than 10 years, earnings compounded at roughly 24 or 25% from 700 odd crores to 5,200 crores this year. Stock has given you 30% compounding. So, well-discovered stock play on commodity, I would say, because their making charges are a percentage of gold price. So if gold price goes up without them doing anything, they get that benefit. Of course, they tinker around with it and discount and all, but broadly, it's a play on gold price. Right. So, there are different ways of skinning the cat. But yeah, silver, we've not even focused because there are few stocks which are a play on silver.
Do you get FOMO about that missed out trade?
Used to. Of course, if I say I don't get FOMO about not just silver, there's so many things. I get FOMO about so many stocks also. But that's a part of the game. As long as on an absolute basis, you're creating your own decent compounding over the years. You have to miss something, you have to gain something.
Yeah, that's true. And I don't feel so bad anymore because if someone like Gautam has missed out on the silver trade, then who are we, right? But it's interesting because silver is not just a commodity anymore. It's become like China is using it almost as a weapon in the whole China-US skirmish, right? Because China controls 70-80% of the global silver, and anything and everything now needs silver, whether it's solar cells, whether it's EVs. So is there more to go?
Yeah, so Sonia, first I would like to make a disclosure that I'm long silver, I'm long silver miners, I'm long gold, I'm long gold miners. So my views should be taken with a pinch of salt because I'm deeply into this trade, and I've been in this trade for more than 5-6 years now. So I'll give you the broad framework on silver. Roughly the global demand is around 33,000 tons. Roughly 33,000 tons is the broad demand. And this demand has been inching up almost 1,000 tons a year. Supply is broadly stuck around 31,000 tons. There is expectation that as price goes up, the recycling of silver will start to come. Like India is a large holder of recycling, but it still doesn't match the demand. Out of this, 60% is industrial. So roughly about, say, 21,000 tons is industrial demand for silver. This industrial demand is actually pushing up the price. This industrial demand 5 years back was 16,000 tons. It's now 21,000 tons. In the next 5 years, this is expected to go to 30,000 tons. So, and silver has been static around $15 to $20 for 10 years. Actually, 15 years. It's been a very stable, commodity, hasn't moved. And some people argue that it was rigged. I'll not get into this because I have no view on that. But broadly, you knew that there is a shortfall coming, and it is coming for exactly the reason that you mentioned, that there is EV, electronics, AI, data center, solar. You can say anything. This is a great conductor of electricity. You need silver in small quantities in almost everything. So if I put demand supply equation right now, it's very clear that this price will go up. Now, my view was it will be triple digit very soon. I was expecting that it will happen in the first 6 months of this year. It may happen faster because commodity prices are very volatile. But I would also say this is not a commodity for light-hearted. It's very volatile. Keep in mind that twice in the last 50 years, it went to $50 and crashed to $10. So you have to keep in mind that unlike gold, which is very steady and which is what I'm very vocal about people should put money in gold because it's more stable. For nuanced and highly investors who understand the risk, silver is a great asset. I would say that it's better to invest in silver stocks now than in silver directly because no analyst had the guts to put $70 or $75 in their model. They're not even at $40 and prices crossed $80. No analyst has the guts to put, because when you put say $70 or $75, the number that you will get of the profit that you get scares you. So the analysts are incremental. I'll do it next quarter. Why should I put it now? What if price corrects? Yeah. So no analyst has the guts. Keep in mind that silver miners sell in advance. So no profits will come this year. So even there are listed silver plays in India, their profits are not going to, quadruple this year because they've forward sold. It'll happen in the next 2 years.
Okay, so this is interesting. You're saying that the better way to play silver now is through stocks. And as we know, copper and zinc, these are metals whose byproduct is silver. So you're saying that in the listed space, it's the better way to look at it is to jump into some of these copper and zinc stocks.
Yeah, because these miners they're not fully priced in for the upside because no analyst actually puts the exact number. They come with a lag. So it's a better way of playing but you have to keep in mind that, these commodities can be volatile. So it's not for somebody who is weak with his heart, because if commodity price correct 20%, as Gautam was saying, that stocks can correct 30-40%. But as I said, I put out the framework. This is the outlook for the next 5 years. So over the 5 years, it looks very interesting. Unless the price goes up so much that there is a demand destruction. So there is a lot of ifs and buts, but they're broadly, I am overweight. I'm not selling my silver. I'm not selling my silver mines. I'm not selling my gold. I'm not selling my gold miners.
But you've been in this trade for very long, right?
I've been for very long. I've been very patient also. Silver didn't do for anything for 5 years. So
he's reaping the rewards now.
Yeah, now he is. I know. At that time, no one used to talk about silver and gold, and Sridhar was the only one who used to go on and on about it. I remember that about 3 years ago.
I think most people in CNBC bought SGB because I pushed them. I literally told them that please, government is giving you free money.
Even on LinkedIn, you've written a lot about SGB.
Yeah.
Exactly.
But my only problem with this is, once it becomes a crowded trade, which it has, then retail gets sucked in the last 10% of the rally. Is that the way to look at it now? If someone's missed out on silver entirely, is it too late?
So again, this is my personal view. Everyone can have a different view. A lot of time we take retail as a very generalized term because retail also comprises of a different set of investors. I'm sure a lot of retail guys would have also made a lot of money in this. But general perception is that in equities, in commodities, every walk of life, retail is always the last. This might have been the case 10, 12 years back, but now there is sufficient information, research that everyone has access to. Right? To use the overabused term, democratization of information has really played out in stock market. Having said that, I think if any asset class, whether it is equities, bond, commodities, if it has done very well, and you miss the big part of the upswing, if you still want to come in, you'd come in with two things in your mind. One, there is higher risk than reward incrementally. Second, you have to be disciplined about it. I mean, what percentage of your net worth or asset allocation you're doing? Well, asset allocation makes a huge difference. If you're putting 1% of your portfolio merely for fun or merely to test the waters, that's a different thing. But if you're committing 10% of your net worth, after the asset class has done really well, and which is a very volatile asset class, like, if there is even a 10, 15, 20% correction after having run up to, it's very, it's possible, right? If something has gone up 200% or 150% in 15, 18 months, it can, for whatever, without any reason, it can come down by 15, 20%. That time, the stock prices can correct significantly too, along with commodities. So you have to be mindful of that.
I just want to add
that realization.
I just want to add here that I was reading a metal newsletter recently, And in that, they highlighted that Indians have bought close to 20,000 tons of silver in the last 6 to 7 years. And a large part has been, consumption has been for jewelry. And if I just do a rough maths on that, the value of that is between 8 to 10 lakh crores. The gain, so they wouldn't have bought, that is the value today. Just the gain out of that
3% of GDP.
is, yeah, it's about 5 to 6 lakh crores is the profit just on silver that Indian women are sitting on. Add to that the 24 to 30,000 tons of gold that Indians have. That is about 4 trillion, roughly 80% of our GDP. And which I repeat every time, that Indian woman is the best fund manager, period. No other debate. We can do whatever we want.
Couldn't agree
We'll
more.
do all the analysis. The Indian woman sitting somewhere deep inside the village has consistently bought gold and silver. She's hedged herself for the currency. She's created wealth for herself. And when it is needed, she pledges that to take a loan and she runs her family with this. Hats off to her. We can do all our analysis. This is the bottom line.
I will obviously, I'll completely support you on that note. A lot
Many
of us,
of my fund managers, they get very angry with this when I say this.
but a lot of us, all of us almost, when we get married, etc., apart from the gold that we receive, a lot of us used to get like silver coins, silver plates, and 10 years, 15 years back, you used to be like, what do you do with all this? You can't even junk it, you can't even keep it, you can't put it in the bank. And now
You're searching for them.
Now you look at it daily and feel good about it.
from the cupboards, all the silver coins and all the silver. Yeah, but it's crazy how things have changed. Okay, so going forward, now all of this is in hindsight, right? Going forward, what is that asset class? What is that pocket? What is that theme which is staring at us in the face and we can't see it? Like, where is the outperformance lie?
How much ever we talk about commodities, equity is the large asset class that one has to be invested in. As I've always said, 10 to 15% in gold, silver, that whatever you can do your asset allocation in this, just to diversify. Like last year, equity didn't give much returns. Gold, silver compensated you, even if it is 10% and goes up 100%, that gives you almost a 10% overall portfolio returns just from gold. Then you add your, other asset classes. Overall, you'll come to about 13, 14% return. Broadly, you have to expect that you'll make about 14, 15% return. If you make on an overall portfolio, you should be very happy. That's the broad framework. I think the same continues, that you continue investing in equity. Over a period, India has done well. We'll have all those cyclical issues. 1 year we didn't make money. Unfortunately, the newer investors in the last 5 years, they came at a time when the markets gave them, a very high returns. That is not the case. I joined in 2003. I joined in 99. And between 99 and 2003, the market gave no returns for 9 years, excepting for the tech boom bust. The market in 2003 was the same as it was in 99. So I've seen the worst of bear markets. I hope we never see that again. But that's how markets are.
But I have an argument to that, okay? I agree. Even I've been in this market since 2008. Now, there was a TINA factors, right? There's no alternative. There was only equities at that time. Now, there's so many asset classes. There are digital currencies. There's Bitcoin, where people are minting money across the globe, okay? And India, whatever you say, because of over-regulation, etc., has completely missed out on the cryptocurrency trade. There is other asset classes, right, that we spoke about, silver, gold, etc. So, do you still feel that when there are so many options, you still feel equities could make that
equity doesn't mean only Indian equities, right? So you can invest overseas. I'm sure Motilal Oswal Mutual Fund and other mutual funds offer opportunities for you sitting in India to invest in overseas equities. So I think it's very much, you can invest in the, Magnificent Seven sitting in India. And if you are slightly rich, you open a LRS account and you can invest overseas. So when I said equity doesn't mean that restricted only to the Indian equities. You can invest overseas. That forms a large chunk. I would say 60-70% of your portfolio roughly should be, maybe 60%. And then you have some debt, and then you have some gold, silver. That's broadly, I would say. I'm a believer of asset allocation. Even though I come from an equity background, I do believe in asset allocation. And I'm not a fan of multi-asset balanced fund, because I believe that I should be doing my asset allocation. If I invest in a multi-asset fund, one asset does well, one asset doesn't do well, my overall returns come down. Whereas if I determine that this is my risk asset, this is what I don't want to lose money, and this is my commodity asset, and I decide what percentage I want, I have full control of that. So my view is you're better off taking control of your portfolio and deciding how much risk you want to take.
What about you? Because he made a point, right, where there was a period of 7-8 years when the Indian markets did nothing. Now, the fear is that we could be headed in that phase again because there are so many other asset classes, but digital currencies are doing very well. Do you think that there could be a lot of pain in terms of time correction in this market where India does nothing for 2, 3, 4 years?
Not my base view, honestly, but it's very difficult to take 7-8 years view in the kind of environment that we find ourselves in. Things are changing every quarter. I mean, I just told you what we projected in FY24 for FY25 is not happening even in FY26. A lot of times our thought process get colored by the recency bias. Last 1.5 year market did nothing, so you try to stretch that argument to 2 more years. If you had this conversation in 2022, a lot of people would have said, okay, we've been in a good bull market, 20% plus earnings growth, Nifty did 22% for 4 years, and this will continue. That didn't happen. The markets are cyclical, something will mean revert. Our base case view now is, on equities at least, is that there is no case for re-rating at least in the next 3 years. We are already at 21, 22 times. Second, we are now in a modest growth environment. Like I was explaining the different components of earnings growth for market, big sectors are still growing in 10-12% band, and that have a disproportionate impact on the index growth. And usually, if you see last 20 years, 25 years, market earnings converges with the market returns. Look at the last 5 years also, 2020 to 2025, earnings growth was 22%, market also gave you 20% returns. Last 1.5 years, earnings growth stagnated. So you can blame Trump, geopolitics, commodities, all of those things, but the moot point is earnings didn't come and markets didn't go anywhere. Now, if next 2 years, like Sridhar was telling, 15% earnings happens, then whatever happens geopolitically or global macros, market will find a way to give that returns in line with. That's our base view, that you will now have returns in line with underlying earnings growth. So if your expectation is 10-12% earnings growth, you have to keep your implied or whatever assumptions you're taking for equity as an asset class for earnings in the similar band. And if you get anything extra, 2-3% for whatever reason, interest rates go down, equity risk premiums go down, you get some re-rating, consider it as your luck. But expectation should be very modest, in line with your earnings growth, because the nominal GDP is growing at 10%. Even 10 is right now a bit of a stretch. This year we will do 8 point something. Next year's assumption that we just published this morning is 10.1% for nominal GDP. And our own expectations for, because budget is 2 weeks down the line, we are talking about 6-7% revenue growth for government receipt and 5-6% expenditure growth, because they have to also manage the fiscal consolidation glide path. So everything can't happen in budget, obviously. So therefore, expectations have to be very reasonable. We've got colored in 2020 to 2022 by the kind of returns that we saw, because a lot of things happened together. The proliferation of demat accounts, big money coming in, earnings growth matching, and generally globally equities as an asset class was picking up post-COVID. So now we are in a normalized environment. So for expectations also have to be normalized. Despite 1.5 years of time correction in mid and small caps, valuations are still rich. 28 times for mid cap, 25 times for small cap at an index level. And index hides a lot of things. If you dig into the index, you will find a lot of stocks which are investable, which you want to invest. They are at 50-60 P still. Right? So if you're buying into those stocks, then your earnings growth better be very strong to support that kind of valuations. So, I mean, the bottom-up job is much difficult when the growth comes down. When the growth is strong, you have more room to make errors. Today, you don't have much of that room.
So no major crash, but a long period of a frustrating wait.
Crash is very difficult to predict, Sonia.
Yeah,
very difficult
no one
to
can predict that. Yeah.
Nobody predicted 2020. Very few people would have imagined 2008 Sensex will be down 52%. So crash is always difficult to predict. It's always hindsight. We can analyze the crash, but difficult to predict. You can predict corrections basis your view on macro, micro, earnings, valuations, all of that. But
you're saying no big correction also.
I won't expect a big correction now that we have spent 1.5 years in a range. Markets have consolidated. There's some time correction in large cap which has happened, and some valuation correction also has happened in large cap. Mid and small cap is where valuation correction has not been enough yet, in my view. So there could, given the kind of flows that you're seeing, $5-6 billion per month, it is very difficult to expect crash. So you might meander along a certain range, allow the earnings to catch up with those valuations. That's the best scenario. That 6 months, 9 months, you do nothing. Earnings come through, which is again very idealistic, because if you see one quarter of 20%, 30% earnings growth in mid and small caps, stocks will find a way to do well. But the ideal situation is your earnings should grow 20-25%. Stock prices should flatten out for some more time, so that then your foundation for next 3-5 years of compounding becomes very strong. Despite 1.5 years of no return, even today, as of today, trailing 5-year CAGR for mid and small cap index is 20 and 24%. So we've done well on a 3-year, 5-year basis. It's only those people who would have come in the last 1 year, they will obviously feeling the brunt of it. And there is obviously a FOMO factor, as Sridhar was explaining.
100%. I mean, when there are no returns in equities,
any other
and then
asset classes, yeah,
silver
people
is
compare.
rallying 200%. Yeah, fair enough. So no case for a re-rating. Keep your expectations moderate, guys. That's what Gautam is telling us. But you made a point about Trump, and I want to talk about that. I mean, no one knows what Trump is going to wake up and do. One fine day, he attacks Venezuela. One fine day, the talks of Greenland. But the point here is that the old rules-based order, that we had seen for so many years, it looks like that is changing now. Some people are talking about America going back to that imperialism. And then what happens so if America is doing what they're doing with Venezuela, what stops China from doing it with Taiwan, restricting, exports of semiconductor chips, etc.? Then what happens? I mean, if this imbalance takes place, how do you read into it as an investor?
Yeah. So one of the reasons for gold doing well is also what is happening globally. One is Fed printing the way it is, so the value of dollars going down. The other thing is uncertainty globally has gone up. So you have the Russia, Ukraine, then you have now Venezuela, now you have Iran. So I think these also add into it. Despite all the noise of war and everything, globally markets have done well.
Yeah.
So somewhere
Still at all-time highs.
yeah. So globally markets are ignoring a lot of these, thinking that these are transient and they will settle down. This will not lead to a major catastrophe. Broadly, I'm in the camp which is that it will not lead into it. Somewhere things will settle down and better sense will prevail. But when we look at, say, India as a country, then we do have some headwinds because of the tariffs. And it does look, at least based on my discussions with various experts, that the tariff discussion could just prolong for a long period of time. There is no immediate, we'll keep hearing good news and then we'll not hear any news. The final signing and, the closure of the trade deal, in my view, could take another 6 months. And some believe that this is more, midterm election related for Trump. I'm not an expert on that, so I will not comment more, but there is a possibility that this just drags along. And when I connect dots of what the government is doing, suddenly we are seeing government wanting to do a lot of reforms. Typically, we do a lot of reforms when you're pushed to the wall. And we've seen a GST reform, we've seen a labor reform, which a lot of corporates tell me that it is very good. I mean, we don't do so much research on labor and how it impacts, but it seems that it is a game changer in a big way. So I think the government has done a lot of reforms on this. It is sort of suggesting to me that government is, and what we've done with currency, that very steadily we've depreciated the currency. The governor gave an interview yesterday where he sort of hinted, and he said in the past that you could see 3.5% of depreciation in the currency annually. We did more than that last year. Sort of hints. The hints are that there's no trade deal immediately, which is a broad negative for India. But we are not such a large export-dependent economy. A lot of the exports like electronics, pharma, many of the spices and many of the other things are exempt in the exempt list. So there are 3-4 sectors like the textiles, gems and jewelry. There are 4-5 sectors which are impacted. I think the government is trying to figure out how to soften the blow. But if you ask me to make a guess, there's no trade deal in the near future.
So there's no trade deal in the near future, and there's a lot of noise. Every day you wake up, there are new geopolitical headlines. As an Indian retail investor, should you be bothered by it? Should you raise your cash levels, or should you just continue your investments in Indian equities?
I think if you follow your asset allocation, you're taken care. Because when the noise is high, there are other asset classes which do well. And I'm assuming if the noise settles down, the asset classes which are doing well, which is gold, silver, and a lot of commodities, they will settle down and the equities will tend to do well. So when you have a broad asset allocation, I think that's why you do the asset allocation, that you don't want all your assets to fire at the same time. There are times when everything moves at the same time, but broadly, that is the logic of doing an asset allocation. And I'm a big believer that you should have an asset allocation and stay put even if the asset class is not doing well, like equities are not doing well. If you make your change in your asset allocation now, that's the biggest mistake you will make. So like you continued investing in gold when gold didn't do well, then you had a period where it did well, then suddenly you will have a FOMO, I didn't invest. So as long as you follow your asset allocation, I think you're broadly fine. That's my view.
Okay, and what about you, Gautam?
No, I broadly concur with him. Just a bit of a twist there. I mean, this is something where you apply your own, view, perspective, analysis. Whenever some asset class is not done well, probably my own temperament is you increase the allocation a little bit, so that when things mean revert, you get that extra alpha. Right. So otherwise, in the last 10, 15, 20 years, Indian equities, even if you've been an index investors, you met 12 to 13% per annum return, which is not bad. S&P in the last 15 years has given you 14% dollar compounding. NASDAQ has given you 21%. Right. So it's not as if only India has done well. In the earlier part of the conversation, we were talking about the options today available to investors. People can invest in China. People can invest in Max 7. People can invest in US.
Now through GIFT City also,
the ease of investing has gone up dramatically, and those who have penchant for doing global investing, they have the tools to do that today. It is up to individuals' risk appetite and the kind of time horizon he or she has, which should help her decide where to put that money. But broadly, asset allocation generally helps in all periods. You rarely get a big FOMO when you have an asset allocation in place. Right? You always feel that, today you would be feeling that I wish I had 20% in gold instead of 10%, but that's par for the course. When equities do well, you will feel I should have 100% in equities or maybe 110%. I mean, there are times when I have personally in my NPS, which is the National Pension Scheme. During the COVID crash, I shifted the allocation from debt to 80% equity, 80% debt to 80% equity. So once in a while you get those kind of low full tosses thrown at you, that time you have to be there at the crease and hit it out of the park. But for that, you have to survive there. So it's a mix of Sehwag plus Dravid plus Tendulkar combination.
But it's interesting because this is also a time when a lot of people compare asset classes, right? And as they say, comparison is like the thief of joy. My house looks good to me only until I see the other person's bigger house. So how do you deal with that? I mean, that's a lot of behavioral finance as well, because you've been in this for so long.
No, but that's natural tendency, right? दूसरों के थाली में हमेशा घी ज़्यादा दिखता है. Grass is always greener on the other side. You have to find your own piece as to where you were in absolute terms 10 years back, where you are today, and where you can be 10 years later. There'll always be 20 people who are more successful than you. Either you feel bad looking at them, or you look back at yourself, your portfolio, and not just in an investing point of view, any sphere of life, right? Whether it is academic, some other pursuit that you're doing, you look back where you were, compare with yourself. If you're better off than where you were, then you've done well. If you're not better off, then you have a problem. You should basically feel happy if you've done well on an absolute basis. Relative comparison, you should leave to fund managers for portfolios. Actually, as an individual investor, what will you do? I mean, let's say for a year, Sensex is up 30% or whatever, Nifty is up 30%, and you are up only 25%. You have no competition as a retail investor to outperform anyone. Do you feel happy with that 25% return you have made? Or you break your head that why I have not earned that 5% extra? a professional fund manager obviously has to explain. That's what everyone gets paid for. But as an individual investor, you should be happy with that 25%. There will be times when you will make more. There will be times when you will make a little less. But as long as on a rolling basis, you've done well, I don't think beyond a point you should bother too much, because the kind of environment that we live in, you will always find 100 people more successful than you. I mean, again, going back to the cricket analogy, should Rahul Dravid feel happy for the career that he had? Or should he look at Tendulkar and feel miserable? Same thing today. Should Gill feel happy about the kind of journey he has had for last 3-4 years? Who would have thought Shubman Gill will become a one-day captain 3 years back? Or should he feel bad that Virat Kohli has done better or Rohit Sharma has done better? So you have to find your own peace.
But is that easier said than done?
It's always easier said than done, because the mindset is always of comparative. And Indians, we've always been brought up in a very comparative kind of environment. Be it education, be it jobs, you have to be number one in your class. You have to crack all sorts of competitive exams, CAT, JEE, whatever. So that mindset gets sipped into your head, and then it gets well entrenched over a period of time. So you keep competing everywhere, and that's the nature of the economy also. We are not a rich economy. So in a way, it's good also that you're fighting and competing, but that should not rob you of your mental peace. So you have to put a limit somewhere and then stay happy with. Otherwise, large part of your life will be spent just comparing and doing, you will not get time to enjoy on what you achieved.
That's true. And I know that you have a son as well who plays cricket, right?
Yeah, son and a daughter.
You have a son and a daughter, okay. So do you pass on that competitive energy to them, or do you try consciously to break that cycle?
See, today it's very difficult to force anyone to do anything. Gone are those days of 90s and 2000 where your parents used to decide what you're going to do. You're going to be a doctor or an engineer. Or today, my son is 16 years old. He has his own view on everything. How much time he'll spend on cricket, how much time he'll spend on studies, how much time he'll spend with his friends doing some other activities. So, I mean, you obviously as a parent advise them as to what he should do, what he shouldn't do. But then they have their own independent thought process. Today, they are not hostage to your views. If you've said something, they have to do it. That's not the case anymore. So they find their own. It's good also, of course, as long as there is a balance on everything.
And what about you? I mean, as someone who is part of such a big family office, there is that degree of comparison, right, between family offices and who's doing better,
Sonia,
or doesn't exist anymore?
Fortunately, the family office that I am with, they're veteran investors. So they've been in the market for so many years. In fact, I learned so much from them. So I think there is no FOMO, at least not in the family office. And even personally, I have no FOMO. I mean, as I said, I'm happy in my space. As you know that, at least once a month I go to the jungle. I'm in the peace. I have no connectivity. I'm with nature. Just remove all the noise. When you come back, you're fresh. You can think,
I think your full-time profession has now become wildlife photographer.
I love both part of my life currently, which is I love the markets. I love the hustle bustle of what's happening here. I also love the peace of the nature. So it's a fine balance. If you can, I managed to get that balance. Touch wood. So I have no complaints. I have no FOMOs. I think it's quite a happy space.
And it's also something he's cracked very well. A lot of people talk about retirement, but nobody knows what do you do after retirement with all that time, right? That's why people are stuck in their jobs or their businesses. They can't stop because they don't know what to do with their time. And you've already developed a hobby that you've taken to this level, which is really remarkable.
I know a lot of people want me to start, they want to come with me for during my travel. That they're happy to pay. I said, I don't want. I'm happy in my space. I don't want unknown people with me. But it's each individual finds his calling, their interest. So I think it's left to each individual. But as I said, at least from our firm standpoint, there is no FOMO. It's a very balanced organization, and they understand markets so well. I think better than me. So.
That he's very much into wildlife.
Yeah, of course.
His big photographs get like millions of views, and I don't know.
I know.
That's amazing. Do you have any such passion that you're working on, or is it like 24/7 work and?
So no, I obviously have a lot of things which I do. I follow cricket a lot. I am a big movie fan. Old movies, obviously not the current ones. I spend hours watching 70s and 80s movies on weekends. I keep watching old cricket matches highlights again from 80s, 90s, and early 2000. I love reading also. I'm not so much of a travel buff. I like just lazing around at home. I like visiting my own hometown, native place whenever I get time, because that is where you.
Where is that?
It's a place called Yavatmal. It's in Maharashtra. It's a few hours from Nagpur. There are a lot of activities which, but the
So there's a
kind
very
of-
beautiful jungle near
Tadava.
Yav. No, it's called Tipeshwar.
Oh yeah, of course.
Yeah,
So
you
it's-
should go there. It's
yeah.
very beautiful.
Yeah,
Since you're from
Tipeshwar.
Yavatmal,
Yeah.
you should go there. And if you need any help, I'm happy to provide.
I think you should start the tours, Sridhar tours.
For friends and people from the markets, I'm fine. Beyond that, no.
Yeah, you were saying?
No, so yeah, cricket is something which keeps me occupied a lot. I read a lot about politics, another passion. In fact, whenever there are elections, I'm more excited to write notes on elections and politics.
So since you're so much into politics, what is your reading, understanding of what's happening, both with, of course, national level politics, but also what's happening in Maharashtra, because the elections are
Yeah,
upon
it's
it.
tomorrow. We got a holiday also. So look, I mean, at a national level, we are in a period of stability, which is extended for 15 years now. And given the way things are, it may extend further. After 84, with that 415 seats when Congress won, we've been in a period of fractured mandates for almost 20 plus years. So a period of stability is something which, it dovetails very well with the markets also. So that could continue given the way the competitive landscape in politics today is. As far as Maharashtra is concerned, obviously we have seen a very strong mandate last October. I mean, if I remember the numbers correctly, BJP had a hit rate of 90% in Maharashtra. They won 130 plus seats out of 145 that they contested. I was reading about not many surveys have come for BMC, but BMC is a big piece because the budget is, as everyone knows, more than a lot of the smaller states. So there are high stakes involved there. The combinations and alignments within the parties have changed, right? I mean, obviously they say no permanent friend and enemies in politics. The early surveys or the predictions that I've read, it seems like there is going to be a change of hand in BMC also in terms of power alignment. So it's going to be triple engine for them in Maharashtra. Assembly is in their hand, Parliament is in their hand, and BMC could also go to BJP plus. But we'll see in a couple of days how it transpires. But it augurs very well that you have a very stable government in one of the largest states which contribute big chunk to the GDP and industrial growth. So we are in that era right now in politics where not much is, the turbulence is very low. I mean, you go back to 1989 to 2014, I mean, survival itself was a big achievement those days. You had seen 4 or 5 prime ministers change in between 1989 to 1997. So it's a good, happy place that we are in right now insofar as national politics is concerned. But like market politics is also cyclical, so we'll have to be always cautious around
Anything
it.
can happen. Yeah. Okay, we've actually come to the end of the show, and thank you so much, both of you, for taking the time out and being here. Now, our show is called The Money Mindset, as you know. So I always end the show by asking every guest about the one mindset shift or mindset change that they have made in their life, which has led them to have such a long-term, sustainable, rich career. So I'm going to start with you, Sridhar.
No, I think to have, it's a very stressful job, especially if you're managing money. So I can speak for myself. So the only way you cut out the noise is if you don't carry your portfolio home. And how do you do that? Because you're constantly in your back of your mind, you have results, your bad results, you have something has happened, stock goes down. So the only way you can do it is if you have other interests. I have multiple other interests. One of them, of course, is travel, wildlife, music. I play the guitar. So, you have some other interest which keeps you away from the noise. Even in my previous avatar, when I was with an MNC, we used to have Blackberries those days. I used to put off my Blackberry because all my emails used to come in the night because all my bosses were in New York. So I used to keep my Blackberry off, that I will look at my email only the next morning. I can't be at your beck and call every time. So it was known to everybody that I will not. So you
set
make
those boundaries for yourself.
you make your boundaries, and then you are able to think. So as you said, this business is all about greed and fear. So if you can overcome that, it becomes far more easy. It's easier said than done, Sonia. It's not like I have not made mistakes, made hundreds of mistakes. But if you make lesser mistakes in your portfolio, broadly 60-70% of your stocks do well. I think you're home. That's the broad framework. So my thing is less FOMO, have other interests, and cut out the noise.
Okay, cut out the noise. Gautam, what about you?
No, so look, I'm in research now for last 17, 18 years. I started my career as a sales guy in P&G. So there's been a dramatic shift in career which happened, in 2007-8 for me personally. Luckily, I enjoy reading a lot. So, and in research, things don't stop, the clock don't stop at 6:30. Right? There's so much you still can learn. So many new sectors are emerging. So many new stocks are coming. So there is no clock which can stop things. So you have to find your own balance, as Sridhar said. How do you stay active, competitive, at the top of your game, and at the same time have the mental peace? So you have to find other interests. You have to take some time off and manage all these things. So the basic ingredients in research always, you have to have a passion for reading. If you don't have, and with the proliferation of so many this chat GPT and other tools, I think that habit is going for a bit of a toss. Everyone wants to compress the reading in 2 pages or 3 pages. So that today it feels efficient. But at some point of time, over a period of time, if this habit compounds, it can create problems also, because the depth of the knowledge can go for a toss then. So reading and then chilling, that's the thing, to put it in a very simple
Chilling, that's the most important thing. Okay, thank you guys for joining me. Thank you. It's been an amazing show, and all the best. Hope 2026 turns out to be a great year for both of you, both in terms of research as well as managing the family office. So thanks a lot for joining.
Thank you.